You just drove your brand new car off the lot. The smell, the feel, the pride. 30 days later, a distracted driver slams into you. Your car is totaled. Your insurance company cuts a check for the actual cash value of the car. But here is the number that makes your stomach drop. You owe $25,000 on your loan. The insurance check is only $20,000. You are now $5,000 in debt for a car you no longer own. That gap between what you owe and what the car is worth is called negative equity. And the only thing that could have saved you is a product called gap insurance. But is it worth buying? Or is it just another way for dealers and insurers to make easy money? By the end of this video, you will know exactly what gap insurance covers, when you need it, and when it is a complete waste of money. I will give you the simple formula to decide whether gap insurance is a scam or a lifesaver for your specific situation. You will learn the secret about how quickly cars depreciate in the first year, why leasing almost always requires gap coverage, and the much cheaper alternative that most dealers will never tell you about. This is not about selling you anything. It is about saving you from a $5,000 surprise. Let me start with the brutal truth about car depreciation. The average new car loses about 20% of its value the moment you drive it off the lot. Within the first year, that number jumps to 30%. In some luxury brands, it can be even higher. Meanwhile, your car loan balance is barely moving because most of your early payments go to interest, not principal. That gap is widest in the first 2 to 3 years of ownership. If your car is totaled during that time, your insurance company pays you the actual cash value, which is what someone would pay for your used car today. That number is often thousands less than what you still owe. Gap insurance, which stands for Guaranteed Asset Protection, covers that exact difference. It pays off your loan so you are not left with a debt for a car you cannot drive. Now here's where it gets interesting. Gap insurance does not pay for your down payment. It does not pay for a new car. It does not pay for your rolled over negative equity from a previous loan. It simply covers the gap between the insurance settlement and your loan balance. And in many cases, you do not need to buy it from the dealership at all. Let me break this down into 3 segments. Segment 1 covers the situations where gap insurance is a lifesaver. Segment 2 covers when it is a total scam. Segment 3 gives you the cheaper alternatives and how to buy gap insurance the smart way. Segment 1. Gap insurance is a lifesaver if you fit any of these 3 profiles. First, you made a small down payment, less than 20%, or no down payment at all. The smaller your down payment, the longer you will be underwater on your loan. Second, you have a long loan term, 60 months, 72 months, or even 84 months. Longer loans mean you pay down the principal much more slowly, and the gap stays wide for years. Third, you bought a car that depreciates quickly. Luxury cars, electric vehicles, and certain domestic models can lose value faster than average. If you check any of these boxes, gap insurance is a smart purchase. For example, a driver who puts 0 down on a 72-month loan for a new Nissan Leaf, an EV with high depreciation, is at very high risk of being upside down. Gap insurance could save them thousands. Let me give you a real number example. You buy a car for $30,000. You put down $2,000. Your loan is $28,000. A year later, the car is worth $22,000. You have paid down your loan to $25,000. The gap is $3,000. If you total the car, your insurance pays $22,000. Your loan still needs $25,000. You owe $3,000 out of pocket. Gap insurance would pay that $3,000. That is a lifesaver. Segment 2. Gap insurance is a scam if you fit any of these profiles. First, you made a large down payment, over 20%. If you put down $5,000 or $6,000 on a $30,000 car, you likely have positive equity from day one. The gap does not exist. Second, you have a short loan term, 36 or 48 months. You pay down the principal quickly and the gap closes fast. Third, you bought a car that holds its value well, like a Toyota Tacoma, a Subaru Outback, or certain Honda models. These cars depreciate slowly, so the gap is small or non-existent. Fourth, you are leasing a car. Wait, that sounds like the opposite. Let me explain. If you lease, gap insurance is usually built into the lease contract. It is called gap waiver or lease gap coverage. You are already paying for it in your monthly payment. Do not buy a separate gap policy. Check your lease agreement first. Also, if you have paid off more than half of your loan, you probably do not need gap insurance. The gap is likely gone by then. And if you have significant savings to cover a potential gap out of pocket, you can self-insure. Why pay a premium for something you could cover yourself? Segment 3. Here is the pattern interrupt that most dealers will never tell you. You do not have to buy gap insurance from the car dealership. Dealers mark up gap insurance by 300 to 500%. They might charge you $800 to $1,000 for a policy that costs them $200. Instead, you can buy gap insurance from your auto insurance company for a fraction of the price. Progressive, GEICO, State Farm, and most major insurers offer gap coverage as an endorsement on your auto policy. It typically costs $5 to $10 per month, sometimes even less. Over a 3-year loan, that is $180 to $360, compared to $800 at the dealership. Some credit unions and banks also offer gap insurance when you finance through them, often at lower rates than the dealer. And there are standalone providers like Gap Direct that sell policies directly to consumers. Always compare prices before you buy. But wait, there is an even cheaper alternative. Some insurers offer something called loan/lease payoff coverage. It is similar to gap insurance but may have different terms and limits. Ask your agent about both options. Also, if you trade in a car with negative equity and roll that into your new loan, you are starting even deeper in the hole. Gap insurance becomes even more important in that situation. But be aware that many gap policies have a maximum coverage limit, often 25 to 50% of the car's value. If you roll in a huge amount of negative equity, gap may not cover it all. Let me give you a real-world example of the dealership trap. A buyer in Florida bought a new SUV for $35,000. The dealer sold them gap insurance for $995, rolled into the loan. They paid interest on that $995 over 60 months, so the total cost was over $1,100. 2 years later, they refinanced their loan. They had to check their new lender's gap policy requirements. They ended up buying a separate gap policy from their credit union for $150. They overpaid by about $900. That is money they could have kept. Now let me talk about the specific situations in the US, UK, and Canada. In the US, gap insurance is widely available from both dealers and insurers. Some states regulate gap insurance more strictly than others. In California, for example, dealers must disclose the cost of gap insurance separately and cannot force you to buy it. In the UK, gap insurance is also common, but it is often called gap insurance or shortfall insurance. The Financial Conduct Authority regulates these products. UK drivers can buy gap insurance from specialist providers for much less than dealers charge. In Canada, gap insurance is sometimes called waiver of depreciation. It works similarly, but coverage limits and rules vary by province. In Quebec and British Columbia, for example, Rules about depreciation waivers are different. Always ask your insurer or broker for specific advice. One more thing. If you are financing a used car, gap insurance is still available, but the gap is usually smaller because the car has already depreciated. However, if you are financing a used car with a high interest rate and a long loan term, you could still end up underwater. Run the numbers. Let me give you a simple 3-step decision formula. Step 1. Calculate your loan-to-value ratio. Divide your loan balance by the car's purchase price. If it is over 90%, you are at risk. Step 2. Check your car's depreciation rate. Use resources like Kelley Blue Book or Edmunds to see how quickly your specific model loses value. Step 3. Ask your insurer for a quote on gap coverage. If the annual premium is under $100 and you fit the high-risk profile, buy it. If the premium is high or you have a large down payment, skip it. Here is another hidden option. Some insurers offer a replacement cost policy, also called new car replacement coverage. If you total your car in the first year or two, they will pay you the price of a brand new car, not the depreciated value. That eliminates the gap entirely. This coverage is usually more expensive than gap insurance, but it is worth comparing. For a car that holds its value well, new car replacement might be better. For a car that depreciates fast, gap insurance is usually cheaper. Let me give you a real-world comparison. 2 identical cars, same driver, same loan. Driver A buys gap insurance from the dealer for $800. Driver B buys gap insurance from their auto insurer for $7 per month, $84 per year, $252 over 3 years. Driver A overpays by $548. Both drivers have the same protection. That is the power of shopping around. Now let me address the biggest criticism of gap insurance. Some people say it is a scam because it covers a gap that should not exist. They argue that if you put down a large enough down payment and take a short loan, you do not need it. That is true. The scam is not the product itself. The scam is when dealers sell it to people who do not need it at prices that are wildly inflated. Gap insurance is a legitimate product for the right situation, but it is also one of the most oversold and overpriced products in the finance office. Your job is to know whether you are the right situation. Let me recap the key takeaways. Number 1, gap insurance covers the difference between your loan balance and your car's actual cash value if it is totaled or stolen. Number 2, it is a lifesaver if you made a small down payment, have a long loan term, or bought a fast depreciating car. Number 3, it is a scam if you have a large down payment, a short loan term, or a car that holds its value well. Number 4, never buy gap insurance from the dealership. They mark it up by hundreds of %. Number 5, buy gap insurance from your auto insurer as an endorsement. It costs $5 to $10 per month. Number 6, check if your lease already includes gap coverage. Most do. Do not double pay. Number 7, some lenders and credit unions offer gap insurance at lower rates than dealers. Number 8, new car replacement coverage from your insurer is an alternative that can eliminate the gap entirely. Here is what I want you to do right now. If you have a car loan, pull up your loan balance and your car's current value on Kelley Blue Book. Subtract the value from the balance. If the result is positive, that is your gap. If that gap is more than $2,000, call your insurer and ask for a quote on gap coverage. Do not call your dealer, call your insurer. You will almost certainly get a better deal. If you are about to buy a car, put at least 20% down. Take the shortest loan term you can afford. And if you still need gap insurance, buy it from your insurance company, not the finance manager. If this video saved you from overpaying for gap insurance, hit the like button. It helps other car buyers avoid the same trap. Subscribe and turn on notifications so you do not miss my next video, which is called The Secret Way to Never Be Underwater on a Car Loan Again. And comment below. Did you buy gap insurance from a dealer? How much did you pay? Share your story and your state. I read every comment. Thanks for watching. Now go protect yourself from the gap. See you in the next one.